Let's start first, Chris, just with whether you see any signs of any type of capitulation or stabilization or making even a short-term or intermediate-term bottom. Do you see anything sentiment-wise or in other technical metrics that tell you that we're getting close, or are we just in free fall?
Joe, to be frank, I just think it's still too early to make that call. This is a market that's probably borderline oversold, but in a downtrend, that's not enough. You need to see legitimate signs of capitulation out there. I want to see put call spiking. I want to see VIX above 40. I want to see the percent of stocks making new lows at about 50 or 60%. We just haven't seen those conditions yet. And I think it really reinforces this idea that in weak trends, the bar has to be higher to make an oversold call, and I'm not convinced we're at that point yet.
Everything that you're describing would take a lot more downside to cause people to get that way. I'm trying to. Would it have to be a quick, sharp, significant decline? Would it be or duration? Can it happen if it? What worries me is if it happens over a period of a month or two, in dribs and drabs, that we'll never get there in terms of sentiment.
Yeah, I think, at a minimum, when you look at some of the survey data, it certainly reflects some stress. But what strikes me is the street is still running long S&P futures. So when we juxtapose positioning versus words may be bearish here, but positioning does not reflect that extreme yet. I think when you look at this over the course of the spring and into the summer, our gut says you finally get some type of good capitulative oversold condition later this summer. We do think it takes some time. You can bounce here and there, but let's not forget there's a lot of resistance on top of this market. Call it 4,300 on the S&P, 340 on the triple Qs. That is very formidable on top of us. And it's a reminder that when you're in a bear market or when you're in a downtrend, resistance matters more than support. Support cannot be relied on. It's resistance on top of you that matters.
Okay, that's interesting. What markets should we be watching in terms of what's correlated? Obviously, the 10-year is something we're watching closely. Suddenly, there's a whole asset class called crypto, which didn't exist in previous bear markets, 1987 or the 90s. We didn't even have that to talk about, but that's correlated. So is everything subject to the same sentiment?
Well, I think, Joe, when you look at rates at roughly 320 this morning, dollar continues to run away. Oil's been firm. So dollar up, oil up, rates up. That's not the best environment for risk. And I just keep going back to the idea that all the speculative assets out there have returned to where they were pre-COVID. So we've seen it with clearly the ARK stocks. We've seen it with a lot of the FANGs. So logically, would Bitcoin have to go there as well? Would S&P have to go there as well? And I think ultimately that's where this is headed. That's, let's call it 35 to 3,700 on the S&P. That brings you back to those pre-COVID ramp levels. I think that's reasonable. When you talk about rates, one thing that I think is really notable here, if you go back to the analog that everyone wants to talk about, 1994, when bonds were in a bear market and stocks were sideways all year, it took the Fed doing 75 basis points in the fourth quarter of 94 to ultimately put the top in bond yield. So I think the chairman removing the 75 basis points from the conversation a few weeks ago, the bond market's laughing at that right now. And I think ultimately it's going to have to come back on the table to arrest this bear market in bonds.
Shepard Smith here. Thanks for watching CNBC on YouTube.